that you do not want to miss. I'm going to explain this to you in 3 simple, fast steps. Step number 1, commodities. Chart, Bloomberg Commodity Overview Index. Starts at 1995, goes to 2020. Our baseline is 100. 1995, we go up a little bit. 2000, we crash. Up to 2005, 2006, where we hit a high of 233. Great financial crisis. Come crashing down. Fed starts QE. That makes commodity prices shoot up because everyone thinks the dollar is going down. Takes us to today, where commodity prices are almost at a historic low, according to this index, at 80. DoubleLine, which is Gunlack's firm, has another chart that shows this beautifully. It's the ratio of commodities to the Dow Jones. At the end of 2017, it was at a historic low, below the 0.2 line that, according to DoubleLine, is radically undervalued. According to Rick Rule, one of the biggest drivers of commodity prices is the expansion or contraction of the economy. This brings us to our first point, where Rick is actually quite bearish because the United States is in its longest expansion in history. Editor, go ahead and throw up that chart. The U.S. has just eclipsed the prior longest expansion in the 1990s. And this chart gives us a great overview going all the way back to 1854. But there are some bullish factors that give us a counterbalance. First, prices have been so low for so long, this reduces the supply. And even if demand stays consistent, if supply is going down, sooner or later, those prices have to come back up. And according to Rick, the biggest bull argument for commodity prices going back up are the 2 billion people in the world that are coming out of poverty. To hear him explain this further, let's go to a recent Real Vision interview. The thing that could go very right, and I don't think is recognized in the market, is the fact that the bottom of the demographic pyramid worldwide, the 2 billion people in the world who are the poorest of the poor, are gaining ground, and they're gaining ground very rapidly. This is a wonderful set of circumstances for humanity, but it's also a wonderful set of circumstances for commodities. When you and I, Western people, gain greater purchasing power, the goods that we purchase, the things that improve our lives, mostly aren't physical, they're services. When the poorest 2 billion in the world gain purchasing power, and they're gaining it very rapidly, they might increase their calorie count from 1,500 to say 2,200. They might change their mode of transportation from walking to a bicycle to a 50cc motorcycle to a Toyota Hilux. They also may trade in that thatched roof for a steel roof, or mud for cinder block. The point is, the bottom 2 people on earth, as they gain extra purchasing power, their purchases are deeply commodity intensive. He also points out that the last bull markets in commodities have been at least 50% driven by China. Now he sees the same things happening to the emerging markets, which should also drive those commodity prices just as high. So good news for the world population and great news for commodity prices. Step number 2, uranium. Rick Rule is extremely bullish on this commodity, and to hear it from Rick himself, let's check out a recent interview.
I don't think that the United States needs to protect its uranium business, among other reasons, because I think the Canadians would be fairly generous selling us Canadian uranium were we to need it. That being said, I like the uranium business. I'm more focused on gold right now because I see gold moving this year and uranium moving next year. But the truth is that when the uranium markets move, the impacts on uranium stocks are more dramatic than any other stocks in the resource sector. As I remember, you were sort of cutting your teeth in the last uranium boom. So you have some memory of the insane share price moves we saw. I remember Paladin 10 cents to $10. What's interesting about that is that investors' memories are still fresh. And when the uranium price does move, the anticipation that you'll see from investors crowding into the few remaining uranium stocks on the planet, I think will be very dramatic. I just can't tell you, sadly, when that will occur.
Right, okay. And the stocks that are left over, are they, I'm sure they're not all good, but because there's so few, what does that mean?
There's an unusually good crop. The truth is, in the last bull market in uranium, we saw the universe of uranium juniors expand from 5, that is almost none, to 500 over 6.5 years. And now you've seen that 500 collapse to perhaps 20. Of that 20, I can absolutely positively recommend, say, 8 of them to intelligent speculators. That's a reasonably high population of good quality companies relative to the universe to select from.
Rick gives us some expert insights. When uranium moves, it moves big. It's like a leveraged way to play a commodity. And he reminds us that Paladin Energy went from 10 cents all the way up to $10. The current price of the uranium ETF is $11, and that's all the way down from 130. So if there is a commodity that's cheap right now, that is definitely uranium. I'd also like to point out that the number of juniors went from 500 all the way down to 20. This reminds us of a very important rule when investing in commodities. The cure for low prices is low prices. The bonus prediction. What does Rick Rule think the greatest black swan risk is in the market today? To find out exactly what a black swan is, let's go to the definition from Nassim Taleb. Nassim Taleb's black swan theory refers only to unexpected events of large magnitude and consequence and their dominant role in history. Rick Rule explains what he thinks the most probable black swan event is by simply stating liquidity isn't necessarily solvency. What does he mean by this? Let's use WeWork as an example. The central banks drop interest rates all the way down to 0, some even below 0. Pension funds, sovereign wealth funds, investment institutions, and individuals can no longer get a yield. This drives all of this capital into funds like SoftBank that promise really high returns. In order to find these returns, they have to go to a tech company that most likely isn't making money. Insert WeWork. SoftBank takes all of this liquidity or cash from these funds, injects it into WeWork to grow the company. But as the company grows, it doesn't necessarily mean that it's making money. And we saw this when WeWork tried to go public. Their valuation then was $47 billion. 3 weeks later, goose egg. When the kimono was lifted and the market actually saw the numbers, they said, no, this isn't WeWork, this is we broke. And SoftBank had to come right back in, inject more money in them just to keep them from going bankrupt. That is how liquidity masks insolvency. So when all that liquidity is sucked right out of the system due to higher interest rates or a recession, that's when all these companies will go broke. Insert your favorite tech company here. As Warren Buffett says, when the tide goes out, that's when we see who's swimming naked. Step number 3, the moment you've all been waiting for. Rick Rule's thoughts on gold. We start with a chart of the 10-year treasury yield. Rick Rule calls this the anti-gold. More on that later. Our chart starts at 1982. It goes to 2020. Back in 82, rates on the 10-year were 14%. They gradually go down until they come to where they are today, right around 2%. So as rates have continued to go down, I want to remind everybody that the prices of those bonds have gone up because there's an inverse relationship between the price of the bond and the interest rate. So if interest rates now are at an all-time low on the 10-year, that means the prices are at an all-time high. Why is this important? Let's go right back to that Real Vision interview. Although many factors impact the gold price, what has been most important for 40 years has been the global investors' perception of the durability of purchasing power of the United States dollar, particularly the US dollar as expressed by the 10-year treasury rate. Historically, when people were afraid, they went into gold on a global basis, not just in the United States. When people have been afraid recently, they go into US treasuries. The US treasuries market, the anti-gold, if you will, has been in a bull market for 35 years, a very long bull market, which I suspect is long in the tooth. If you believe that the anti-gold bull market, that is the US Treasury market, is at the end or close to an end, then you must believe, conversely, that the gold bull market is closer to the beginning. If the 10-year Treasury and gold are competitors for the safe haven asset of choice, the closer we are to a bubble in the 10-year, the closer we are to a bull market in gold. Which brings us to the next competitor for gold, the United States dollar. Historically, the dollar has had a slight edge because there aren't any carrying costs. With gold, if you store it, then there's a little bit of an annual cost to doing so. So we would call that a negative carry. But now it's a much different story. Editor, go ahead and throw up that chart of interest rates compared to inflation. Going back to 1960, the Fed funds rate has almost always been above the rate of inflation. And of course, that's using the government's measurement of inflation. But this is very important because this shows us that 99% of the time we have positive, real interest rates in the United States. That means that the level of interest is higher than the rate of inflation. Since 2009, it's been the opposite. The rate of inflation is higher than interest rates. And this is interest rates on the short end of the curve, the Fed funds rate. So if you have your money in a bank account yielding 0.5%, and the rate of inflation, as the government tells us, is 2%, you're losing 1.5% of your purchasing power per year. That is a negative carry. And I'd like to point out the last time that we had interest rates lower than the rate of inflation for a consistent period of time was way back in the 1970s. And we know the result of that was rapid inflation. So because the 10-year is in a bubble, we can cross that off the list. The United States dollar has a negative carry. In fact, now it's an even bigger negative carry than gold. So we can cross that off the list as well. And we haven't even talked about the fundamentals of the dollar or the 10-year, which is the US budget. Let's go right back to Rick Rule and check out the debt clock. If you're not convinced that the US is in trouble, just give me about 30 seconds. People inside and outside the US don't seem to understand the arithmetic of collective indebtedness in the United States. And I'd like to point out that one of my favorite Rick Rule quotes is arithmetic always beats narrative. Oh, but wait, there is more. Let's check out the US debt clock, and these numbers are moving so fast, I can barely read them. The U.S. national debt, 23 trillion. U.S. federal deficit, over $1 trillion. U.S. total debt, when you look at unfunded and interest payments, at $75 trillion. That means that the debt per citizen is $70,000 and the debt per taxpayer is $187,000. I know those numbers are tough to even comprehend, so let's look at this at a household level so you can better get your mind around it. We've got insolvent Sam, and he might be your uncle, so we'll call him Uncle Sam. Uncle Sam is $10 million in debt, but his income is $50,000 a year. The problem is that Uncle Sam spends $200,000 a year. So how is he ever going to make his debt payments if he loses an additional $150,000 a year? The next question would be, would you rather lend your Uncle Insolvent Sam money, or would you rather buy gold? Now that we've not only crossed the competitors off the list, but we have smashed them to bits, what does Rick Rule think about the gold miners? This is a question I get all the time. He's very bullish, and he always uses a specific chart to illustrate this. Editor, let's throw up that chart right now. Currently, the Barron's Gold Mining Index is right around 600. And if we draw a line to represent the historic mean, it's right around 800. And this is the justification that Rick Rule gives for the miners currently being cheap, historically speaking, especially when you compare this to all the quantitative easing and money printing the Fed has done since 2009. Remember, their balance sheet is currently close to 4.5 trillion. Before 2009, it was approximately 800 billion. That's a lot of additional money supply. So miners look good on a historic basis, but I want to point out that if you buy miners, I don't see that as an investment. I don't see that as insurance. I see that as a pure speculation. But right now, that may be a good speculation. Rick Rule gives us another incredible insight. The percentage of the average portfolio that investment funds and the general public have typically allocated to gold is 2%. And that's gone as high as 7% in the past. Right now, we're only at 1%. If we just revert back to the mean, Rick thinks that could drive the gold price as high as $5,000 an ounce. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.